Hi, I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. It's September 2025. Our goal with these Atlas videos is to provide informative, unbiased insights into popular investment products and strategies. Today, we'll look at income ETFs, which generate income by selling call options on stocks. One income ETF in particular, JP Morgan's Equity Premium Income ETF, which I'll call JEPI, has become the world's largest actively managed ETF with $41 billion in assets. The marketing has been brilliant, but is it brilliant investing? Well, not really. A closer look shows that JEPI simply repackages stock market returns without improving the risk-adjusted performance, and it's especially unattractive for taxable investors. So here's how JEPI works. If you invest $100, $85 will go into U.S. large cap stocks, and the rest will mainly go into equity-linked notes, or ELNs, which embed call options sold on stocks. The net effect is a covered call strategy. Now, on that topic, my partner Jono and I have previously recorded a video that you could refer to for more information in our opinion. The important thing to note for JEPI is that embedding these sold call options in the ETNs reduces JEPI's effective stock exposure by about 20%. That means your $100 invested in JEPI gets you the $85 in long stock positions, offset by about $20 worth of negative exposure to U.S. stocks with the call options, and so you're net long about 65% in U.S. stocks. So what's a good benchmark for this strategy? Since on average JEPI's effective stock market exposure has been 65%, a close fit to JEPI is a simple strategy with 65% in the S&P 500 index and 35% in U.S. Treasury bills. Since inception, JEPI's volatility has been nearly identical to the volatility of this 65-35 mix. But JEPI's annual return was lower, 11.7% for JEPI versus 12.7% for the 65-35 mix. The takeaway here is we are comparing two ways to get to 65% equity exposure. One is simple and one's quite complex. And the simple strategy wins. And the gap with the simple strategy doing better than the complex one widens even more after taxes. Of the 11.7% annual return of JEPI, 9.1% to almost 80% of the return came from the yield. And the yield is mostly option premiums on the sold call options. Option premiums are taxed in the current year at the highest ordinary income tax rate. In contrast, with our 65-35 stock bill strategy, most of that return, 10.6% of the 12.7%, was capital gains. And on capital gains, taxes are deferred until you sell, and then they benefit from lower tax rates. So JEPI accelerates your taxable income and pushes it into the least favorable tax category. Even JP Morgan's prospectus highlights this, as they disclose about 1/3 of JEPI's return would have been lost to federal taxes, and there would be even more state taxes depending on your state. And that compares to only a minuscule sliver which is lost to taxes on distributions for VOO, which is Vanguard's S&P 500 Index ETF. Other areas of concern regarding JEPI are shown here. There's very high turnover in the equity strategy, 174%, which means the average holding period is just 7 months. There's extra costs in addition to the 35 basis point stated fund fee from all that trading, from the option transactions, and from putting those option transactions in structured notes. There's counterparty risk. The structured notes create exposure to the other financial institutions, and if there's a concern about the stability of the financial system, then the credit risk for those could have an impact on the fund outcome. The income is a bit uncertain. In part, the payouts depend upon the price of volatility, which isn't a usual exposure for retail investors. And finally, it's a truly active equity strategy. At present, the strategy is significantly underweight U.S. infotech relative to the weight in the S&P 500 index. It's offsetting that with tilts toward more defensive sectors like staples and healthcare. So to conclude, let's just fact check JP Morgan's claims. JP Morgan says that JEPI captures a majority of the returns associated with the S&P 500 with less volatility. Well, that's true, but the simple 65-35 stock bill mix does that just as well. The strategy has time-tested bottom-up fundamental research. Now, that's kind of hard to square with the frantic turnover. And moreover, there's very few active U.S. large-cap strategies that manage to add value over time relative to the simple S&P 500 index. So the fund has consistent monthly income even in volatile market environments. Now, the yield may look steady, but that's because the ETF's volatility goes mainly to the capital gains. Finally, JP Morgan says indeed it has an attractive yield. But as we pointed out here, the yield is high only because the investment returns have been shifting out of capital gains to income, and that makes the tax treatment worse and not better. So that's our take on equity income ETFs like JEPI. They may sound appealing, but once you look closely, there is not an apparent investment advantage over simple strategies that have the same stock market exposure, and it's a quite poor choice for any taxable account. So if you own an income-oriented ETF like JEPI, or you're considering adding strategies like that to your investment portfolio, I hope this information has been helpful to you. Thank you for listening.